everyone. Good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi, and here's what we have lined up for you today on this daily 1 hour long dose of personal finance. First up, the latest news from the RBI was that fixed deposits and new and fresh fixed deposits doubled in the first quarter of FY21. That's April to June 2021. This, mind you, despite the fact that banks have had to slash interest rates as the RBI too cut interest rates significantly since the beginning of the COVID crisis. So why then are individuals still attracted to your traditional mode of fixed deposit investing? And what are the other options out there? That's what we'll be discussing in the very first segment. We'll also be preparing you for tomorrow's RBI policy, what the outcome could be, and what impact will the outcome make on you, on your next EMI bill, or for that matter on your interest income as well, is what we will be discussing. And finally on the show, the latest tranche of the sovereign gold bond scheme is available for subscription. We'll be reviewing the SGB, as it's commonly called, versus other forms of gold investments. How do they pitch against each other? And with gold now at not 50, not 53, but 55,000, can an SGB enable you to participate in this massive run-up? All of this lined up on the next 1 hour right here on The Money Show, so stay tuned. And of course, don't forget, we'll also be taking on board your questions and queries. So to talk on the very first topic of today, let's bring on board Mrin Agarwal, the founder director of Finsafe. Mrin, always a pleasure having you with us. Thanks so much for joining us today on The Money Show. So interesting data coming in from the RBI. The RBI actually said that, even though fixed deposits were generating extremely poor interest rates, still 6 lakh crore rupees, that's the amount deposited in banks' fixed deposits in Q1. That doubled from last year. Last year during this period we had 3 lakh crore rupees. This year 6 lakh crore rupees. What does this tell you, Mrin? I mean, are people so worried about what's happening in the economy that they rather have a return that they know that they are going to get, because that's what basically fixed deposit can guarantee?
Hi, Mubina. Thank you for having me on the show. Well, yes, I think it's extreme risk aversion right now. Given a couple of things, first and foremost, the whole pandemic, the way it's played out, again, there's a lot of uncertainty in terms of incomes, in terms of what the economic impact is going to be on the long term. And then if you were to really look at it from an investments perspective, every asset class is pretty much at the peak, right? As you said, gold at 55,000, equities are somewhere back to their high levels again. Even debt markets to that extent are at all-time lows in terms of interest rates. So I think, given all of this, I feel people are being really cautious right now. And even though the deposit rates are continuously falling, I think people are still putting money in fixed deposits for that reason.
Mrin, I just want to also take in your opinion on the fact that from a macroeconomic angle, okay, and this is something that sometimes retail investors are not very savvy with, or they just tend to avoid that discussion altogether. But we have the dreaded inflation, which is actually the worst enemy of your money. And the latest inflation reading was 6%. Now compare that with your 1 year fixed deposit rate. And you will wonder that, whatever you're earning in a fixed deposit, it's all being eaten away by an inflation. So why all the more do people tend to go towards that? And all the more your opinion on why, a fixed deposit, just a fixed deposit investment is really detrimental.
I think, people don't take into account fair inflation. And many people don't actually understand. I mean, I'm not saying that they don't understand inflation, but they don't understand the impact of inflation on your money, because that's the only reason that I can think of why people, put money in traditional instruments which don't beat inflation. I think many of times people are also not looking at the printed inflation numbers on a regular basis. And it's also, this anchoring bias that is there, that For generations, people have been putting money in FDs and they have been considered very safe. So I think somewhere the safety factor like really overrides all other considerations.
And you can't blame them, right? I mean, we have seen so many, unfortunately, we've seen a couple of debt funds as well, right? The Franklin schemes being shuttered down, which means that people are not going to be able to redeem money from those funds. And all of that paints a very scary prospect. Plus, of course, the economy as well is in doldrums. So that's why people are also hesitant on putting their money in the share market. So I guess that safety factor does play a very, very big role, more than the return prospects factor for people flocking towards fixed deposit. So Mrin, are there any other instruments available out there that could offer maybe a better return compared to fixed deposits, while providing maybe the same element of risk or lower?
So if we were to look at the really short term, I mean, essentially you're seeing like a 6-month fixed deposit at like 3.5 to 4% basically, and shorter term rates are like 3% right now. And these I'm talking about the large nationalized banks. Now, see, there are two other instruments that are there. One, of course, is fixed deposit from small finance banks, which are pretty much giving at least 50 to 75% higher return. So if you were to look at it on a 1-year basis, a 1-year FD from a nationalized bank is giving you 5%, whereas a SFB deposit is giving you 6.5%. So, these options are there. However, I would say that it's better to just limit it to 5 lakhs because, again, there are so many small finance banks, there are so many other smaller banks that are available. But as we know, the deposit insurance amount, the deposit insurance guarantee is 5 lakh rupees for a depositor in a bank. So that's option number one. Option number two is to go in for short duration debt funds. And within this, you have the overnight funds where the maturity is 1 day and there's no risk of default out there. The returns are in the range of 2.5 to 3%. Again, you have liquid funds, which you can look for periods of 1 to 3 months. And then you have the ultra short term funds, which can be considered for periods of 3 months and upwards, basically. So in terms of the returns, of course, there would be a slight variation. And I think compared to the fixed deposits, I think the debt funds would maybe be able to give you between 0.25 to 1% higher, depending on the tenor of the investment. And of course, the benefit that you have with the funds is the fact that you can withdraw it at any point in time, compared to FDs, which sometimes are a bit inflexible.
Okay. All right. Now, and I think this is all the more an important discussion to have because tomorrow we have yet another RBI monetary policy meeting outcome. So if in case the RBI decides for yet another rate cut, that is also again going to reflect, on the next time you go to renew your fixed deposit. It's not going to be a pretty picture that your interest certificate will paint, that's for sure, because interest rates are only on their way down, given the fact that the RBI as well has said so by saying that they want to maintain a very accommodative monetary policy stance. Mrin, wanted to get in your sense on, liquid funds. As we know, savings accounts as well, because of the fact that, interest rates are so low, banks have cut interest rates on savings accounts and on term deposits. So many a times, and now, of course, the whole process has become very easy. What corporates do is, as a part of their treasury actions, they park some funds in they park some money in overnight funds, sometimes in liquid funds. Do you advocate that for individuals as well, that look, if you don't need some money which is lying in your savings account, instead of earning close to nothing or just that meager 2% or maybe lower than that also now, you should perhaps transfer it off to a liquid fund? Would you advise that sort of money management?
And but one thing that we have to keep in mind is that the savings account interest is 2.75%, but you have Section 80 TTA benefit up to 10,000 rupees of interest on savings account. But certainly, if the amounts are bigger and the interest is going to be more than 10,000 rupees, you need to move it out into liquid funds, because they certainly give you a better return than what the SB account is giving you. So, and I know like a 0.25 or a 0.5% extra return does not sound very high, but then when you compare it to a 2.75% return, certainly you're better off putting money in a liquid fund and earning that extra return.
I want to get in your opinion on small finance bank FDs. Compared to, a State Bank of India, HDFC Bank, one of your bigger banks, PNB, etc., a small finance bank like, Jeevan Small Finance or Jana Small Finance, they tend to give you that extra interest rate on the fixed deposits. But again, why what would be a reason why I wouldn't put my money over there, or what would you recommend, since they provide that extra interest rate? And again, the fact that it's a fixed deposit means I know that I'm going to get that 7% or 8% return, which is very good in this environment. So would that be a good option?
I think it's fine, as long as you can keep a track on the capital adequacy and the gross NPAs of the bank. See, there are so many of them, so certainly one will have to do this check. And many a times I find retail investors not really able to do these sort of checks. So, which is why I would still say that if you're, you can try them out, but if you're unsure about it, limit your investment to 5 lakh rupees, because that is what is basically covered under the deposit insurance guarantee scheme. As such, all these banks are regulated by RBI. And I think now, with all the problems that we've seen, I'm pretty sure that there's a good amount of regulation. So from that perspective, I don't really think that investors need to worry.
Okay, good amount of regulation. You need to, I think it would also be important to understand that you will perhaps have to keep track of certain parameters like capital adequacy ratio, etc., of these banks, which would be available on their website. So it's important to understand that there's a good amount of regulation as well. Remember, the RBI had recently taken into its ambit cooperative banks. So that as well is something worth noting, different of course from small finance banks, but it's worth noting. It's worth noting that point as well. What about corporate fixed deposits, Mrin? Wanted to get in your opinion on that.
Actually, I'm not really in favor of corporate fixed deposits, because although you might have AAA rated deposits available, again, most of the corporate fixed deposits are from NBFCs. Somehow I feel that the concentration risk is very high in these deposits, So, for example, if there's a person who's, putting a fair amount of money into these deposits, and if something happens to any of those entities, then the entire money is gone, because, the priority of the fixed depositor is way at the bottom, right? So I feel that it's a risky bet to go in. Maybe one or two names is okay, like maybe an HDFC Limited is okay. But I think, on the others, somehow I would kind of prefer to take exposure through a debt fund, because the first thing is that I'm not locking into one or two deposits and having a huge amount of concentrated risk there. And the second thing is, again, liquidity, because in a debt fund, I can remove my money whenever I wanted. Whereas with the company deposits, there are certain restrictions, like you cannot remove it for the first 3 months. And then, of course, there's a penalty for partial withdrawal and stuff like that. So in terms of liquidity, and diversification, I think the debt funds work out better than company fixed deposits.
Okay, diversification is the key issue when it comes to corporate, corporate fixed deposits. Yes, they may offer a higher interest rate, but if there is a default, your entire money is gone, and that can be a pretty scary prospect. So finally, before I move on to our viewer queries, Mrin, like you mentioned, we are in this entire age of uncertainty. We don't know what's next. We don't know what shape or form the coronavirus can take next, which in turn will again hamper, markets, economy, our own jobs, etc. So in light of all of this, how do you advise the split between, your risky assets, and when I say risky, I mean, equities, etc., versus the relatively lower risk, for example, fixed deposits, fixed income securities, debt funds, liquid funds, so on and so forth?
Well, I would always say that it should be based on your financial goals. And, there's no thumb rule to say as to how much should be. But even then, if somebody is not able to decide, it's very simple. If they have 100 rupees, they need to decide in this 100 rupees, how much of it am I wanting to put at risk and how much is it that I'm not wanting to put at risk. So a lot of people tend to go with, let's say, 30% in risky assets and 70% in safe assets, or 60-40 basically. But yes, that's for people to figure out based on their risk taking ability. And secondly, they need to take risk, because sometimes you might have to take more risk if the amount that you have to invest for a goal is smaller. But overall, it's really based on your comfort with taking that risk.
Okay. Great. There you have it, folks. Yes, you may, put your money in fixed deposits, but don't put too much of it. Keep your own risk appetite in mind as well, because do remember, at the end of the day, fixed deposits are not going to be able to give too much of an interest rate, because we are in this low interest rate environment. And tomorrow, who knows, maybe the RBI may again cut, interest rates by another 25 basis points, which will further lower FD interest rates the next time you go to renew them. Okay, let's take on board some questions and queries then we have coming in, and you too can email us on themoneyshow@etnow.tv. Our very first question is coming in from Deepak. He says, I have fixed deposits in a Deutsche Bank account. He wants to know if he should hold or withdraw. Please suggest if it is safe to continue the fixed deposit. Okay, I get why he's asking this question, because we've seen quite a few banks as well unable to repay depositors, PMC Bank being one of the most prominent ones, and a whole host of smaller cooperative banks as well that have found themselves in a bit of an asset liability mismatch sort of a situation, and that in turn has led to them not being able to repay depositors, or depositor money being stuck. In the history of the Indian banking system, though, proud to say that there has never been a case where the depositors have not got back a single rupee. Yes, they may have had to take a bit of a haircut, but never been a case where they've not got back a single rupee. So, Mrin, Deutsche Bank, any opinion that you would like to offer Deepak, any view?
To continue, looking at capital adequacy, and the gross NPA ratio is pretty low. And of course, foreign banks are regulated by RBI as well. I think that, from a safety perspective, he can certainly continue.
Okay. It's an okay bank. You can continue. The ratios look okay. Capital adequacy, gross NPA, all of those look okay. So you could continue your fixed deposits in Deutsche Bank. All right, let's take on board our next query, which is coming in from Sridharan Arukavil. He says, please advise whether fixed deposits in some of the PSUs like a PNB Housing Finance, LIC Housing Finance are safe. And he also wants to know if he can extend FDs in Mahindra Finance and Bajaj Finance. So basically fixed deposits with the NBFC space. What's your opinion on that, Mrin, keeping deposits with NBFCs like these?
So, as I said, I think the concentration risk is very high. Yes, I mean, on the PSUs, there is that degree of comfort that it is backed by the government. So, and as we've seen that in the history of banking, as you mentioned, we've really not seen depositors losing money on fixed deposits. So it should be okay. And but the whole point is again that there is a concentration risk, and that's something that, and of course, the liquidity risk, because again, with some of these deposits, you can't withdraw it for 3 months, and then for 3 to 6 months, there's a penalty for withdrawal. Similarly, after 6 months, the penalty reduces, but the penalty is still there. So I would still suggest that if he can, he should look at, and since he has a time frame from a year is what I'm thinking, I think he should certainly look at alternatives like a low duration fund.
Okay. All right, Sridharan, there you have it. There is that certain amount of discomfort, for Mrin when it comes to putting your money in some of these names because of the high concentration risk. So even if it's an NBFC or a corporate, just sort of avoid doing that. Okay, moving on, we have Parth Batabyal, who's writing into us saying that he has a couple of funds in his portfolio wherein he's investing 4,000 rupees per month. There are 7 funds, HDFC Mid Cap, and there's a Sundaram Mid Cap. So 2 Mid Caps. We also have a Nippon India Small Cap, 2 multi-cap funds, Kotak Standard Multi-Cap and Motilal Oswal Multi-Cap, L&T Emerging Business and SBI Mutual Fund. So 7 funds in total. He says he's been holding the funds since the last 3 years. He wants to know if his portfolio is okay. Unfortunately, he's not listed down his age or his goals, but we'll assume that he wants to invest this for the long term, for wealth creation. He also wants to know if he can invest in the share markets for long term, where I believe when he says share markets, he wants to start investing directly into individual shares. Okay, so it looks like he's a novice investor and he started investing also in the funds only 3 years ago. So Mrin, firstly, is the mix of his funds right? And I guess Mrin, in a way, he's done the right thing by starting off with mutual funds and then, mulling share investments. As in when you educate yourself. So how would you recommend he go about investing in the share markets too?
Right, so I think 7 funds is too much to have, and he should kind of really restrict it to 4 to 5 funds. One thing that he's done is that he seems to have spread himself out between multi-cap, mid-cap, and small cap. But I think he needs to do some consolidation out there, and I would suggest that he could look at exiting the L&T Emerging Business and the Sundaram Mid-Cap Fund. There is some underperformance in some of the other funds that he's been holding, but I think he should look at holding these from a longer term perspective. Now, as far as buying stocks directly is concerned, I really would not recommend it because most investors really do not have the sort of information available to decide what stock is right to buy. And also, they tend to buy on tips and generally then try to buy penny stocks or try to do some trading and stuff like that. And that doesn't work out. I know that there's this big trend right now on buying stocks and especially buying blue chip stocks. But I think, you're better off doing it through a mutual fund because I seriously don't think that most retail investors have the right information to decide which stock to buy. Secondly, the sectors keep rotating, right? So there's no one sector which is always the best performing sector consistently. And every quarter or every year, the best performing sector also tends to change. And finally, I find that most investors, especially retail investors, find it very difficult to decide when to sell a stock, especially if that stock is an underperforming stock, right? So I feel that it's better to just leave all these decisions to a professional money manager and invest through mutual funds. And if he wants to actually add on, I think he should just add on to the existing mutual funds that he's already got.
Okay, fair enough. So 7 funds is too much. That's extremely important to understand that one mutual fund already is investing in almost 50 to 60 companies, and then you're adding on more funds. There will be a lot of commonalities as well between both of them, so it just leads to over diversification when you invest in too many mutual funds. All right, moving on. Anshuman Kumar writes into us saying, please advise if I should hold the UTI Dynamic Bond Fund and the ABSL Dynamic Bond Fund. I've invested 6 lakh rupees in each portfolio. And he has a portfolio which in total stands at 1 crore rupees. He also wants to know if he needs to shift to another debt fund. He's not given us a breakup of how this portfolio of 1 crore rupees has been split across different asset categories. That would have been helpful. But yeah, if you could explain to our viewers what exactly are dynamic bond funds, and UTI and ABSL, are these good dynamic bond funds to hold and keep?
So dynamic bond funds can basically, invest in bonds with multiple durations, basically, and they can shift between bonds. Unlike a short duration bond fund, which needs to have a specific maturity of bonds, the dynamic bond funds can basically shift between durations. And essentially, dynamic bond funds are managed to play on the interest rate calls. So basically, when interest rates fall, then you'll see dynamic bond funds doing really well. And when interest rates go up, then you'll see that these funds would take a hit. So essentially, they play on interest rate movements. Now, as far as these two funds are concerned, I don't know how long he's been holding those funds because he hasn't mentioned that. But if we were to presume that he's been holding it for more than 3 years, I would say please exit, because again, we saw that both these funds had some credit defaults. There are segregated portfolios there in both of these funds. And from what he's written, he basically also wants to invest somewhere for the next 1 to 2 years only. So, given the fact that the interest rate cycle has also played out and we are at the rock bottom as far as the interest rates are concerned, I think it's a good time to basically move out from these funds and invest. If his goal is 1 to 2 years, he'll have to look at a couple of low duration funds.
Okay, well, there you have it. Anshuman, I hope you've taken note, of that answer and, how dynamic bond funds as well work. Okay, well, on that note, we're timed out on this edition of Ask the Money Show. Folks, if we've not been able to answer your query, don't fret. You can email us on themoneyshow@etnow.tv. We'll be here every day at 5 p.m. to get your questions and queries answered. Mrin, really appreciate you joining us today as well on The Money Show to help our viewers out and, of course, explain to us the whole environment that we are in the midst of that's pulling people towards a safer and a guaranteed return asset investment instrument like fixed deposits. Okay, well, folks, on that note, we will take a very short break right here on the show. Don't go anywhere.